Guys, it's me again. Today we're going to chapter 3 is about T accounts. So how T accounts work is you have to assets are always on the left side of the T account. Liabilities and owner's equity are on the right side of the, equal sign. So every account we're going to put in a T account. Assets always increase on the left side, and the left side of a T account is a debit side. Assets decrease on the right side, and the right side of a T account is the credit side. Liabilities are on the right side of the equal sign, so liabilities increase with credits and decrease with debits. Owner's equity, except for two accounts, increase with credits because credits are on the right side and debits are on the left. So let's see how this works. When the transactions are going to stay the same, but now we're going to analyze them like we always did. But instead of saying plus and minus, we're going to identify the accounts that are affected, like we did in the past. We're going to classify them as assets, liabilities, or owner's equity, like we did in the past. We can determine the increased side for each account, and we're going to apply the left and right side rules. And we're going to make the entry in the T account. Here's the initial investment. So in chapter 2, when he said the initial investment of cash, this particular investment was $10,000 for personal use. What two accounts are affected? I'll give you a second. That hasn't changed. It would be cash and capital. So you have to say to yourself, cash is on the left side of the equal sign, so it's going to increase on the left side of the T account, which is the debit side, and capital is the other account that's affected, and it's affected with an increase. And since capital is on the right side of the equal sign, it's going to increase with a credit. Okay, next transaction. The Wells Consulting Services issued a $5,000 check to purchase a computer and other equipment. So analysis, they gained an asset and they lost an asset. So now we have to say to ourselves, when you gain an asset, you gain it with a debit, and the debit for an asset is on the left side. And when you spend money, you spend cash, you're going to credit it, and you credit cash on the right. So you increase assets with debits and you decrease them with credits. You purchased equipment on account. So that hasn't changed. You know the two accounts, equipment and accounts payable. But now you always have to say to yourself, if assets are increased on the left side of a T account is a debit, and liabilities increase on the right, and the right side of the T account is the credit. If you purchase supplies for cash, what two accounts are affected? Supplies and cash. So you think about the fundamental accounting equation and you say to yourself, I increase assets with debits and I decrease assets with credit. Every transaction has to have a debit or a credit, or you could have two debits and two credits, but the debits always has to equal the credits. One more. You pay a liability. Okay. So you say to yourself, when I pay someone money I owe them, I now owe less. So just do what we did in chapter 2. You say to yourself, accounts payable goes down. How do you decrease accounts payable? You decrease it with a debit. And how do you pay anybody? You pay them with cash. And how do you decrease cash? You decrease it with a credit.